Okay, very warm welcome everyone to the session on green bonds from the Global Research Alliance from Sustainable Finance and Investment. So it is my pleasure to welcome you all to this session. We are represented across all time zones today. So we've got myself presenting from Australia and our panelists joining from all over. So it's my great pleasure to welcome you to this session. So we've got 3 papers today. I'm very much looking forward to the various presentations we have got on the topic of green bonds. So we are starting off with our first paper, raising the questions, why do firms issue green bonds, by Julien, Duan and colleagues. We have got our second paper that is looking into is carbon risk priced in the cross-section of corporate bond returns. And this will be presented to us by Frank, Weikai and colleagues. And then we've got our third paper looking into the preferential treatment of green bonds. This will be presented to you by Matthias, Kaldorf and colleagues. So if you've got any questions, please feel free to put them through to us, and after each presentation we'll have about 5 to 10 minutes for questions and answers, and hopefully we'll also have a little bit of time at the end in case there are any additional questions. So please, anything you would like to know, anything you would like to ask, please put that in the chat and the comments will be forwarded to me to moderate then the discussion section. So I guess we'll proceed right away with our first presentation. So I'm inviting Julien to present the first paper to us, and I'll hand over to him, and very much looking forward to this first presentation in our session. Thank you so much.
Thank you, Martina. Thank you, everyone, for attending. Can you see my slides? Can you hear me?
Yes, all good.
Very good. Thank you. So this is going to be applied economic theory and some econometrics on on green bonds and why firms use them. Sorry. I'm doing this research with my colleagues and friends, Shema, Frédéric, Mitali, and Jean-Charles Rochet, here in Geneva. So I think the very new thing with green finance is that it allows investors to link their investment decision to firms' environmental performance, firms' commitments. Green bonds are probably the most emblematic green finance instruments, and they commit issuers to use the bonds proceeds to finance climate-friendly projects. It is well known that a corporation like Apple has largely used green bonds to finance its energy transition. But also very rapidly increasing numbers of corporations have used green bonds in the past few years, generating this green bond boom. And the objective of this research is to understand why firms have been used green bonds so much lately. When one looks at the empirical literature that examines the green bond boom, it shows that it works in some sense. So more precisely, the literature highlights the 3 following main results. One is that green bonds are not, so they don't seem to be greenwashing. That is, green bonds issuers do significantly reduce, very largely, in fact, reduce their CO2 emissions post issuance. Second, the stock price of issuing firms rises when they announce green bonds. So they are, in technical terms, abnormal returns at issuance. So green bonds benefit firms and their shareholders. And the third point is that certification is critical. In fact, the first 2 results only hold for certified green bonds, whose commitments are verified externally ex post. So how to interpret these results? How to make sense of all these? So much research has first looked for a green bond yield spread, so a difference in the cost for firms of green bonds relative to conventional bonds. The idea would be to explain that firms benefit from better financing conditions offered by concerned investors, and this would explain why firms use green bonds and why, as well, the stock price of these firms rise when they announce a green bond. But in fact, this literature has find estimates of the green bond spread that are very low, in fact, virtually zero. So that means that the marginal investors is not sufficiently, does not sacrifice enough of its returns so that green bonds are cheaper for firms. So in other words, investors' concern has not yet played a significant role. This may change, hopefully, but to explain the success of green bonds in the past few years, one cannot rely on investors' concern. So our theory is different. It is to say that managers use green bonds to signal something about their project's quality, their project's economic efficiency to investors, and that this is what generates abnormal returns. And managers do that because they like to increase their stock price. So more precisely, our theory consists of two main ingredients. One ingredient is that firms' green bonds are a signaling device. The idea is that only firms with the most efficient green projects would commit to their financing. So firms' green bonds signal something about projects' economic quality, and that explains abnormal stock returns. And the second ingredient is that managers are sensitive to their firm's current stock price. This has been called short-termism, and it has probably various facets. So, for example, one facet of short-termism was of a manager's sensitiveness to their firm's current stock price is captured by the structure of their a manager's compensation. Manager's compensation consists of stock components, for example, stock options with relatively short vesting periods, and this provides managers with incentives to inflate their stock price in the short run. There are other factors of short-termism, managerial short-termism, that have been documented in the literature, such as stock share turnover, the attention of markets to short-term results, risk of takeover, speculation, etc. Okay, I would like to be very brief on that, but I'd like to make crystal clear that we do not recommend to replace carbon pricing by green finance. We adhere to the economist's traditional recommendation that carbon should be priced. But our view is that governments, despite economist recommendations, have not used carbon pricing to an adequate extent, and this translates into very large carbon pricing gaps. This is probably explained by political reasons that we do not discuss in our research. But if you like, our view is that given the urgency of the climate problem, one should look at everything that seems to be working. The green bond boom is one of these things. It seems to be effective environmentally. But if we like to promote green bonds, then we need a consistent theoretical foundations and empirical analysis. It is exactly where we would like to intervene. I hate to do that, but I'm going to have to skip 2 slides about the literature. In a nutshell, green bonds are voluntary, and so green bonds commitments are corporate social responsibility initiatives. And in the end, I would like to convince you that there is something very special with the green finance commitments that do not obey the usual logic of corporate social responsibility. Okay, let me now jump into my models that I'm going to try to present in a couple of technical slides. Sorry for that. So our model describes an industry in which there is a continuum of firms. Each firm has some regular activities that are well known. And on top of their regular activities, each firm has a single incremental project. All of these projects requires to invest 1 unit of capital at date 0 and generate the same revenue Y at date 1. So there are going to be 2 dates, 0 and 1. At date 0, firm's manager will have to decide whether their project is undertaken in a green or in a conventional way, which will be indicated with the index K. okay, G for green or B for brown. If a manager does the project in a green way, then the resulting CO2 emissions, XG, are going to be lower than if the project was conventional, XB. I assume that there is a form of a carbon penalty. I will call it a carbon price for simplicity at rate tau. And so this carbon price penalizes, is expected to penalize green projects less than conventional projects. There is something else. Each project has its own type that will be denoted by I in the 0-1 continuum. And this type indicates the economic efficiency of the project. More precisely, if the project is done in a conventional way, the cost of the project will be CB. So this is, the business as usual, conventional technology. It is well known, perfectly observed by everyone. However, when the firm does a project in a green way, then on top of CB, it will incur an additional cost that I will denote delta CI. And this is rising in I. That is that when I, the type of the project I is low, then the project is more efficient when it is green. When it is high, it means that the project is less efficient. Moreover, unlike business as usual conventional technologies, green technologies are harder to assess from the perspective of investors. And so I will assume that this type I is a private information of managers, but is not directly observed by investors. Now, all projects are financed by bonds for simplicity, and all bonds repay the same. So I assume a way that there is a significant green bond yield spread. Moreover, I assume that all green projects will be financed by certified green bonds. So this will allow investors to take into account the certified green technology in their investment decisions. So in the end, to sum up, the profit generated at date one by an incremental project is the net revenue, Y minus R, the revenue minus the cost of the bond, of the capital, minus the cost of the project that depends not only on the technology, but also of its type, carbon pricing, plus some noise. Managers care about this expected future profit, the expected future profit from their projects, which is this part here. This is the objective of managers. So they care about that. This V here accounts for the other revenues of the firm, the other profits from regular activities, it is well known. But they not only care about future profits, they also care about their current stock price, which is denoted by SK here. The current stock price may depend on the technology, because the technology, thanks to green finance, is certified, and therefore investors can take this technological choice into account. So this alpha here, and there in the 1 minus alpha, is the weight of the stock price components in the total objective of managers. So it's going to play a crucial role. It captures the sensitiveness of managers to the current stock price and to current stock price reactions. I will also call it the degree of short-termism, because it provides managers with incentives to inflate the stock price when they make the technological decisions. So what we have in mind is that we start from a situation in which the stock market doesn't know, investors in general don't know whether a firm's projects are going to be green or not. Then managers decide whether their projects are going to be green or not and certify green projects. And investors react to that. So there is a stock market reaction that follows the announcement of green bonds. In period one, things are boring. The production takes place, bonds are repaid to bond investors, and the remaining profits accrue to shareholders. The resolution of the model is not so simple, but in fact it can be explained with two main equations. The first equation is about managers' decision to make a project green or not. It tells that managers will choose the green technology for their project if the type of their project is relatively low, it is lower than the cutoff type IE. So that is if their project is relatively efficient when they are green. And the cutoff project, the marginal green project, the marginal project that is financed by green bonds, is determined by this balance between the cost of making a green project, which is the cost of green projects less the penalty differential due to carbon pricing. So the balance between the cost, this net cost of a green project, and the stock market reaction, because a green bond will send that positive signal to investors, and that is valued by managers because of this alpha here. So managers value the stock market reaction to their green bonds in a way that depends on their sensitiveness to the stock price alpha. This is an increasing relationship. That is, the stronger the stock market reaction, the more green projects and green bonds there will be. The second equation is about stock investors' reaction to managers' decision. And it tells that stock investors react to green bonds in a way that depends not only on carbon pricing. When you do a project green, you know that this project will be less penalized in the future, but also depends on the expected cost of this project, expected efficiency. But investors are rational and take into account that, so they assess green projects and firms, knowing that firms have undertaken these green projects because they are relatively good. This relationship is decreasing. The more green projects, the less efficient is the marginal green project. And so the lower, the less pronounced the stock reaction will be. So the first relationship is increasing, the second one is decreasing, and in the end we are looking for the rational expectation equilibrium in which managers and investors know the reaction of each other. And this is at this intersection here. If there was no green finance, there would be no possible stock market reaction to green projects because green projects will not be certified by green bonds. We would be on the horizontal axis here. In fact, we would be exactly here at I0. So you see that thanks to green bonds, there are more green projects, i.e. here. And one can play with curves, shifting curves, to see that both tau, carbon price, and alpha, the sensitiveness of managers to their current stock price, would increase the proportion of green projects. Okay, so this proposition basically tells what I just said. Besides, we make the minimal linear assumption that delta C function is affine, so as to obtain a linear testable prediction for how green bonds increase the number of green projects. This expression here tells that this is the total effect of green bonds. It is always positive. It consists of two terms. One term is positive and one term is negative. This term that is positive is a term in alpha tau. It's the interaction between carbon pricing and managerial incentives. In some sense, it is important because it tells that for a given carbon price level, thanks to green bonds, carbon pricing is more powerful, is more effective. Its effect is amplified by green bonds. The second term is negative, but one can show that the sum of these two terms is always positive. So what we would like to test is the total role of alpha here, the total role of managerial incentives, of managerial short-termism. So we do that by using data on green bonds. Actually, we focus on certified green bonds again. We have estimates of the effective carbon price that are provided by the OECD. And in what I'm going to present today, I'm going to use one proxy for short-termism, which is the pay sensitivity to the stock, the manager's pay sensitivity to the stock price. A measure called WPS, so that is due to Edmonds, Gabet, and Landier, and that is very close to what we have in the model because it captures the weight of stock components within CEO total compensation. What else? We use other data on firm and industry characteristics. So I'm going to focus on this WPS measure as a proxy for short-termism, the weight, again, of stock components within managers' compensation. You see, for example, in this diagram, so, you know, on the horizontal axis, you have this WPS measure indicating the average weight of stock components in managers' compensation in various sectors. And on the vertical axis, you have the proportion of green bonds. And you see that sectors in which managers are the most sensitive to the stock price, okay, on the right of this line, are also the sectors that use the most green bonds. So what we would like to do is slightly more complicated. We would like to make use of our model testable prediction to test our theory. So in this linear model, we have, you know, the interaction effect expected to be positive, carbon price times short-termism captured by WPS, plus a terms in WPS expected to be negative, and we hope that the sum of these two terms is positive. That will be the real test of our theory. When we estimate this model using the data I just quickly described, we obtain exactly what our model predicts. That is that the coefficient, so this is, you know, the estimate of beta 1, it is positive. The estimate of beta 2 here is negative. But the most important thing is that the sum of both, when you multiply this term by the average carbon price, for example, or even a lower carbon price, is positive. So that shows that the total role of WPS, so the considered proxy for short-termism, the total role of short-termism, manager short-termism, is positive in line with our prediction. Firms in industries where managers are paid with more stock options do more green bonds. By the way, the significance of this term is very important because this term is the coefficient of the interaction term. So it means that for a given level of carbon price, managerial incentives augment the effect of carbon pricing. All right, so what time is okay? So there are other things we do in the paper. So for example, we consider all the facets of industry short-termism are like, for example, captured by the stock share turnover, and we obtain basically the same thing as I just showed for the WPS proxy. We also examine abnormal stock returns. We also examine the effect of green bonds on CO2, because that's a very important assumption of our model. We examine that effect using recent green bond policies in some countries as an instrument. We also extend our theory to the presence of concerned investors, because, you know, our view is not that investors will not remain not concerned by the environment, that investors concerned may generate a green bond yield spread in the future, hopefully, and this may change the picture. But if you like, our extension shows that there is no qualitative change in the testable prediction and in the way we should run the econometrics. All right, so to conclude, I think we developed probably the first formal analysis of firms' incentives to use green bonds by presenting a model that examines firms that act on both the bond and the stock markets and undertake green and ordinary projects and financing the former through green bonds. And we show that managers use green bonds to signal their project's efficiency in order to increase their stock price, and we test this prediction. And that has one nice implication, that is that with green bonds, carbon pricing becomes more effective. So it is probably practically interesting for governments. But to sum up, green bonds are booming. They seem to be effective, and they seem to be very complementary with carbon pricing. Although their effectiveness is likely to be a matter of managerial interest and short-termism. And this is what is very different with green bonds and the classical view of corporate social responsibility. Thank you for your time and attention.
Thank you so much for your presentation, Julien. That was very interesting and a lot of great insights from your study. So I'll just see if we've got any questions from the audience for you. I just check in the chat. I can't see anything coming through at the moment, so I'm just going to throw in some questions of my own. I was really interested actually in your findings. I was wondering if you thought about any particular effects that we might see depending on any particular project type or any particular industry. I saw that you were factoring industry in to some extent. I was just wondering in terms of, your findings, whether you saw any particular results that were relating, especially in terms of signaling to particular projects that firms undertook, or whether or not you saw any stronger, implications in some sectors where I guess that signaling might be, stronger compared to other sectors, perhaps. Yeah, thanks.
No. I'm so sorry, by the way, the sound is very bad on my computer, so I could hardly hear you. But you're asking if we find like something that is very specific to some sectors that suggest something about the signaling effect.
Yeah, that's correct. Yeah.
So far we've not really looked into that. One comment we got sometimes was that. Maybe so in our theory, investors are interested in the economic information, whether projects are good or not, financially speaking. And others suggest that they may be interested in the environmental performance. But I think this would be contradicted by the fact that there is no significant green bond yield spread. Okay. So another story would be that firms use green bonds to sort of, advertise their environmental commitments to consumers. But it seems that green bonds are very, are really target investors rather than consumers.
Okay, thank you so much. So I just see if we've got any other questions. Does anyone else have a question for our presenter at this particular point?
Yeah, can I ask something right away from here? Okay, cool. Sure. Do you have? I mean, it's always a bit complicated to present such a rich model in that short period of time. So maybe I just missed it. Did you compare the effectiveness of this green bond issuance or certified green bonds to a carbon tax in like on the so you mentioned it's kind of a substitute, but how well does it substitute a carbon tax or other like tax instruments?
So it is not a substitute in the sense that without carbon pricing, in fact, there is no effect of green bonds. So the carbon pricing is so I didn't talk about that, sorry, but you need a positive, strictly positive carbon price, so green bonds generate a stock market reaction.
Okay, so it's more like a complement to that kind of policy.
Yeah, exactly, and what I think is probably the most important result is this positive term. Can you see my slides?
Yeah.
So you see, this coefficient is a coefficient of the interaction term that is predicted by our theory and that we test here. And the fact that this coefficient is positive means that for a given level of carbon pricing, when managers have stronger incentives, are more sensitive to their stock price, they do more green projects and green bonds.
Mm-hmm.
Okay? So in that sense,
but that is following from the modeling assumption that if you would not have a carbon price, the green bond is dominated kind of by using the conventional bonds in some sense, because it has this green project has this additional cost term.
In fact, the model predicts that if there was no, so in what I presented, I assume that there is a strictly positive carbon price. If there was no carbon price at all in that model, investors will not react at all. There is a discontinuity actually.
Okay.
And investors will not react at all. So this, this will be 0. This will be 0, and we would end up, the proportion of green projects will be exactly the proportion of green projects without green bonds.
I see.
But that's that's a relatively technical aspect of the model. So
no, I'm just because it's a bit different to what I'm going to present in half an hour, and I tried to square those two notions. But okay, I think I understood how it works roughly. Okay, thank you.
The complementarity is that with a higher carbon price, the stock market reacts in a more pronounced way because green projects are going to be less penalized, and that amplifies the stock market reaction. And managers care about that. They care about that because they are paid according to the current stock price.
Julien, I've got one additional question for you. So in the interest of time, it might be good if we can get just perhaps a very short answer to that one. So the question is regarding the incentives provided by achieving a lower cost of capital. So how much of an incentive is achieving a lower cost of capital to issuing green bonds? That's the question for you.
So to take into account the fact that the green bond yield spread is very small, in the model, I assume that there was no spread. So no cost of capital benefit to firms using green bonds. However, in the extension that I mentioned, with concerned investors, there is a spread that emerges. And the extension shows that there are two mechanisms going on at the same time. The mechanism that I presented today, based on stock market reaction and managerial incentives. And on top of that, this mechanism is augmented by the emergence of a green bond yield spread. So they are not of the same nature, but going hand in hand.
Okay, thank you so much. So in the interest of time, we'll just be moving on to our second presentation for today. So thank you so much. And we send a round of virtual applause your way for your presentation. So I'll invite the second presenter for today. So we have Frank Weikai with us, and he is presenting today regarding the question, is carbon risk price in the cross-section of corporate bond returns? So I'll hand over to you for the presentation, and we very much look forward to hearing from you on this topic. Thank you so much.
Thank you very much, Martina, for the introduction. So can you hear me and see my slides?
Yep, all good, all good.
Okay, good. So this paper, so first I want to thank the conference organizer, including our paper in this forum. And this paper is co-authored with Tinghua Duan from ISAC School of Management and Quan from Georgetown University. So the motivational paper is to look at whether the carbon risk is priced in the cross-section of corporate bond return. So the big picture question is that we know temperature rising and there are more extreme weathers and sea level rise associated with the rising temperature. And scientists broadly agree that accumulation of greenhouse gas is the main reason why we observe increasing temperature. So any regulation, if are going to target or solve the climate change problem, have to significantly curb carbon emissions of firms and other organizations through some pricing or quantity mechanism. So they sometimes refer to the carbon bubble issue. According to some estimate, if we burn all the fossil fuel reserves that already discovered, then we are going to generate around 2,700 billion tons of carbon emission CO2. Well, if we are going to stay below 2 degrees Celsius, as said by the Paris Agreement, then we can only burn around 1/4 of that fossil fuel reserve. So many of the assets that are currently on the balance sheet or the market implied in the market value of fossil fuel companies may not actually usable. So, so in the future, or already in place, government around the world already implement some type of regulation on carbon price or cap and trade system. So the effect of the more stringent government regulation is likely to be heterogeneous and the most relevant for carbon intensive firms. So this can be due to a direct cost on the firm's operation, and can also operate through a financing channel. So as the ESG investing become mainstream, this firm with high carbon intensity will face higher financing costs due to more stringent climate capital requirement and the trends toward sustainable investing. And some countries currently may not impose stringent government policies on carbon emission, but they may implement such policy in the future when the global climate worsens unexpectedly. And this can lead to a lower firm value when climate change matters most to investor welfare. So given this risk, a natural prediction is that if investors are rational, they should already demand a high expected return for holding security issued by carbon intensive firm. So this is sometimes referred to the carbon risk premium hypothesis. And they find some evidence, the literature found some supporting evidence using equity and other asset class. In this paper, we are going to examine whether there is a carbon risk premium in the US corporate bond market. So the reason we look at the corporate bond market is that more stringent government policy on climate regulation mainly constitute as a downside risk to carbon intensive firms. So it should matter more for bond investor compared to equity investor. So this is because the payoff of the bond is equivalent to a short put option on firm assets plus some risk-free bond. So you can see that from the payoff structure, the bond actually are more sensitive to the downside compared to the equity. So that's why we should probably able to find a stronger carbon risk premium in the bond than equity market. And another main reason is because the investor clientele are quite different between equity and the bonds. So in US as well in other countries, corporate bonds are mainly held by institutional investors, and they are deemed as more sophisticated and likely take carbon risk into account compared to retail investors. In fact, there's a survey paper by Kruger, Salton, and Starks found that more than 50% of institutional investors believe the regulatory risk of climate change is already materializing. And examining the bond also allows us to test the underlying channels because bonds have a natural heterogeneity in their characteristics such as ratings and maturity, which allows us to test the underlying channels of the pricing or mispricing of carbon risk. So to give you some preview empirical results, we measure firm level carbon intensity using firms CO2 emission scaled by its total revenue. So this is consistent with industry practice and also academic literature. And then we link the firm level carbon intensity to the cross-section of corporate bond return issued by these firms. And we find evidence that are quite surprising. We find the carbon risk premium hypothesis is not only not supported in the US corporate bond market, but actually the evidence goes against the carbon risk premium hypothesis. So we found that the bonds issued by firms with high carbon intensity are indeed riskier as measured by their bond market beta, higher downside risk, lower credit rating, and less liquidity. Yet these bonds issued by high carbon intensity firms actually underperform by around 2% per year relative to bonds issued by firms with low carbon intensity. And we found that this low carbon premium or low carbon alpha actually persists after adjusting for various systematic risk exposure and controlling for a comprehensive list of bond characteristics using Feynman-Mabbas regression. So this is the long-short portfolio, the cumulative return from a long-short portfolio, taking a long position in the firms with the bonds with low carbon intensity and short the bonds with high carbon intensity. So we find a consistently positive low carbon alpha in our sample. And so given the results actually is inconsistent with the carbon risk premium hypothesis. So what other theories can explain the quite surprising low carbon premium in the data? So we mainly test the two alternative hypotheses that are recently proposed by some theoretical studies. The first theoretical paper by Pastor, Stumble, and Taylor, they argue that although in equilibrium, given that concerns for the climate change and also taste for green assets, the green assets should earn lower return. However, during the transition process from past the world to the low carbon economy, the green asset could actually perform better than brown assets because the investor their demand will push up the price of green assets and push down the price of brown assets. So if you calculate the realized return over this period, you may find green asset actually earn high return than brown assets, although in equivalent, in the long run, the green assets will underperform. So we test this explanation and using institutional ownership of corporate bonds. And first, we find indeed investors actually divest from bonds issued by carbon-intensive firms. So institutional investors indeed walks the talk, and they divest from bonds issued by more carbon-intensive firms. However, we find that this invest preference hypothesis cannot be the full story underlying the low carbon premium. So we find it can explain around 20% of the low carbon premium in the data, but the remaining part cannot be explained by the shift in investor demand. So the second alternative hypothesis that can generate such a low carbon alpha is proposed by Patterson et al. In a recent paper. So it argues that green assets could actually earn high return if being carbon efficient, also indicate a strong firm fundamental, and the market haven't underreact to this predictability of fundamental. So essentially, this is a behavioral story. And our evidence is most consistent with this hypothesis. We find that high carbon intensity indeed can predict a firm's fundamental beyond other usual characteristics. So we find that, for example, high carbon intensity firms have lower cash flow needs in the future, and they are more likely to experience downgrading of their bonds. And also they are going to experience more frequent environmental incidents. So, so in terms of contribution, our paper is most linked to the recent fast-growing climate finance literature. So there are two types of climate risk as argued by regulatory agency and also other industry reports. So the first type is the physical risk arising from the cost of the natural disasters that are amplified by climate change. Our paper actually focuses on the transition risk of climate change. So the carbon emission itself is not harmful to a company. It's only the expected cost imposed on firms that are carbon intensive that can be detrimental to its value. So there are some recent papers look at the pricing of carbon risk in equity and also in options. And while we focus on the corporate bond market, and we find very different results. So in terms of data, we get the corporate bond pricing data from the enhanced version of TRIS. And we merge, so this data is mainly about the secondary market transaction and the pricing of the bonds. And we also merge this transaction level data with merging to get the issuing characteristics of bonds, including offering amount, maturity, and the coupon rate. And the bond return, monthly bond return is calculated in a way similar to stock. So mainly the change of price of the bond plus some cash flow. So for the bonds, the PI is the clean price. And if you want to get a total price, you need to add up the accrued interest. And then we also add up the cash flow, which is for bond is the coupon. And then we divide the total price of the bond in the end of last month, which is the denominator. So this is the bond return measure, then which is standard in the literature. And then we merge with firm level carbon emission data from S&P true cost. And our sample includes around 20,000 bonds issued by 1,100 firms. So to be clear, our paper is not about green bonds. Our paper is about much larger, the plain vanilla bonds, and their pricing can also be affected by the firm's carbon intensity. So carbon emission data at firm level is from S&P true cost. And according to greenhouse gas protocol, there are three scopes of carbon emission. And the true cost contains all three scopes. And our main focus is on scope 1 and scope 2 because the data on scope 3 is more sparse. And many occasions it's actually not reported by the firm. It's actually imputed by the data vendor. Our main measure of firm's carbon emission is an emission intensity measure, which is tons of CO2 equivalents divided by firm's total revenue. So this is standard metric to capture the carbon efficiency of a firm, which is both used by practitioners and also academic studies. So this figure, first we plot the average carbon intensity in the time series. So we can see that for scope 1 carbon emission, there is a declining trend, especially after the Paris Agreement, suggesting that the carbon efficiency of firm indeed increased at the reporting company level. However, there are not much time series variation for the scope 2 and the scope 3 emission. And then we look at the industry difference in terms of carbon intensity. So not surprisingly, there is a huge cross-sectional variation of carbon intensity across industries. So the three most carbon intensive industries are utility, energy, and chemical, which is not very surprising. So to route this industry effect in our return predictability and the pricing test, we actually conduct the asset pricing test within industry. So we're essentially comparing firms that in the same industry that are most carbon intensive versus the most carbon efficient. So this can route any industry level pricing effect. And also it's sometimes adopted by the practitioners, which is called the best-in-class approach. And you may wonder whether there are still variation of carbon intensity within industry, and we find this indeed the case. So the lower panel of the figure shows you the within industry standard deviation of carbon intensity. So even within the industry, for example, within a utility company, there are firms that are more carbon efficient and then there are firms less carbon efficient. And we are looking at the difference in the bond return of the different firms within the same industry. And we use a various factor model to adjust the expiry return of the bond and also control for the risk exposure to other standard factors. So the main model we are going to use is a 4-factor model by Wen. And in their model, in their paper, they show that the bond market factor and the downside risk factor, the credit risk factor, and plus the liquidity risk factor is the best model to explain the cross-sectional variation of bond return. So we conduct a standard portfolio testing to examine the pricing of carbon risk. And first, we sort all the bonds into quintile within each industry and then average across industry. And the portfolio returns are value weighted. So this is our main results. But we can see that if we move from the low quintile to the high quintile, the carbon intensity by construction actually monotonically increase. However, we find that the average return and also the alphas of the portfolio actually decrease from the lowest carbon intensity quintile to the highest quintile. And long-short portfolio is around the 16 basis point, which is equivalent to 2% per year. And given the bond average return is not high to begin with, this 2% return spread is considered economically significant. And then we look at whether this the low carbon alpha can be explained by the risk difference between the different quintiles. So we find that actually the risk exposure only makes the results worse, because we find high carbon intensity bonds actually are riskier than low carbon intensity bonds. As we can see that the highest quintile of bonds always have the higher risk measure, such as high beta, high downside risk, and the lower liquidity. And then we examine whether other bond or firm characteristics can explain the negative association between carbon intensity and the bond return. So we found that we conduct a test using Farmer-Mabbas regression. So we control for a set of bond characteristics that are shown by the literature to predict bond return. And also we construct other risk processes, such as default beta, term beta, and uncertainty beta. And this is the Farmer-Mabbas regression results. We can see that whether we control for these characteristics or not, the coefficient on carbon intensity is always negative when we use that to predict the future bond return. And when we then conduct a battery of robustness test for the predictability, and we find the results are quite robust. So the main question is that given we find very surprising results, what theories can explain the low carbon alpha? So we first turn to the testing the investor preference hypothesis. The idea is very simple. In a world when more and more asset managers are committed to divest from fossil fuel firms, the divesting process itself can generate such large pricing pressure. So the green assets will be bought more by these asset managers. So they will have high realized return in this period, while the brown assets will have lower return due to the dumping by the asset manager. And this seemed to be a plausible story given the enormous rise of the asset managers that commit to divest from fossil fuel industry in the recent decade. So we first test this explanation using institutional holding of corporate bond from Refinitiv Emacs database. So this institutional holding of corporate bond, which is similar to the 13F. So we examine whether the institutional investors indeed divest from bonds issued by carbon intensive firm. So we first check whether the investor indeed works at all. However, simply finding the institutional investor divest from the fossil fuel or carbon intensive company is not enough. We need to show whether this divesting process itself can explain the return probability of the carbon intensity for future bond return. So in the second stage regression, we actually include the contemporaneous change of the institutional ownership of corporate bond and see whether it explains away the return probability of carbon intensity. So first, the set of results is about the change of institutional ownership of corporate bonds. So we indeed find that high carbon intensity bonds have reduced the institutional ownership in the future. So this is consistent with the divestment story. However, when we include the contemporaneous change of institutional ownership of corporate bond, we find it cannot fully explain away the return probability of carbon intensity. So the coefficient on carbon intensity is still significantly negative when we use that to predict the future bond return. So this suggests that the institutional investor preference cannot be the full story underlying the low carbon alpha. So we then examine the second major alternative story, which is the invest underreaction hypothesis. So the low carbon, according to that hypothesis, being carbon efficient also indicates the firm is more efficiently run, so have strong firm fundamental. And if we invest underreact to this credibility, then we should find a low carbon alpha in the data. So we first test that using some measure of bond level information asymmetry. So the idea is that the return probability the underreaction should be stronger for bonds that with less transparent information environment. And we find this is indeed the case for the return probability. The low carbon premium is stronger among non-investment grade bonds, also among the less liquid bonds, which are usually less informationally transparent compared to investment grade bond and high liquidity bonds. And we also conduct a time series test based on investor attention to climate change issues. So we use Google search to measure climate change concerns of the investor. And we find that the results is only there. So the low carbon premium is only significant when investors have low searching activity or low attention to the climate change issues. So that, again, this is consistent with underreaction story. And we then direct test the story by looking at whether the carbon intensity are able to predict the future firm fundamental and cash flow news. So we use 3 measures of firm cash flow news, including SUE, unexpected earnings, and unexpected revenue growth, and also earnings announced return. So using all 3 measures, we find consistent evidence that high carbon intensity firms have a lower cash flow news, and investors are more likely to be negatively surprised by these high carbon intensity firms in the future. And to link it more closely with bond return, we see whether this return probability, the fundamental probability, can also lead to change of firm credit worthiness as measured by bond credit rating and also the O score. So the idea is that if low carbon intensity, the carbon efficient firm have strong fundamental, that should indicate that the future credit rating of these bonds should be improved. And that can lead to a higher real return of the low carbon intensity bonds. So we find this indeed the case. The high carbon intensity firm indeed experience a more deteriorated credit worthiness in the future. And lastly, we examine what is the channels through which the carbon intensity are able to predict the firm fundamental. So our conjecture is motivated by some anecdotal stories, as some firms that have poor environmental profile or their top managers are not very concerned about environmental risk, and that can lead to persistent violation of environmental regulation. And these firms are more likely to face negative environmental incidents. So we use rep risk to measure the ESG incidents. And the rep risk is not a firm level ESG score. It's actually a ESG incidence measure as captured by news. So it's less subject to manipulation issues as a conventional ESG score. So we test the relation between carbon intensity of a firm and the frequency of environmental incidents. So we found that the high carbon intensity indeed predict more frequent environmental incidents in the future. So this can explain why the carbon intensity itself can predict future firm fundamental. So if it can lead to more environmental incidents, then these carbon intensive firms may likely to suffer reputational loss, and they are likely to lose customer interest or revenue, and that can lead to a lower fundamental in the future. So to conclude this paper, in this paper, we find evidence actually contrary to the carbon risk premium hypothesis. As a document by recent studies, we found that bonds issued by firms with high carbon intensity actually earn significantly lower future return. And then we test the two alternative explanations that can potentially generate such a low carbon alpha. And we find evidence is most consistent with the inverse underreaction story, as we find a high carbon intensity firm have lower future cash flow news, deteriorating firm credit worthiness, and more environmental incidents. So the inefficient pricing of carbon risk in the bond market suggests that may have some implication for financial stability. So in the future, when investors reprice the risk of carbon, it can generate a sudden negative shock to the bond market. And it can also suggest that the climate mitigation policy are not very effective currently, because the high carbon intensity firms, they are not penalized enough. So this is implication of our finding of inefficient pricing of carbon risk. So, so that's all my presentation. Thank you very much for your attention.
Thank you so much for your presentation, Frank. We have one question that came through earlier for you already in the presentation. And one of our participants was asking essentially regarding including also stocks in your model. That was right at the beginning of your presentation when that question came through. Did you just want to provide a brief answer to that question now? I'm not sure if you saw that coming through on chat earlier.
Yes, let me see. The question is about
yeah, how would the model change when you include stocks?
Okay, yeah. So actually, we conduct a test using the stock market, and we found the consistent evidence as the bond market. So, so especially for stocks with corporate bonds, we essentially find the same results. The stocks portfolio with high carbon intensity actually earn significantly lower alpha and a lower return than the stocks issued by firms with high carbon intensity. So this suggests, because our story is about carbon intensity implied firm fundamental, and the firm fundamental, because both stocks and bonds are payoff that dependent on firms' underlying fundamental. So it should generate the same return capability across bond market and the stock market. And this is essentially what we find. However, there is a caveat, because not all public firms issue corporate bonds. So within the sample, the whole sample of stock, we find essentially weaker results. So this is the results for the entire stock market, including those those firms without a corporate bond issued. And here we find weaker results, essentially insignificant results. So among the sample of stocks that indeed issue corporate bonds, we actually find the consistent results.
Wonderful, thank you so much. In the interest of time, I'm now going to invite our third presenter for today. So that's Matthias, and we are also sending a virtual round of applause to you. So thank you so much for presenting your paper to us today. And now we will hear from the third presenter regarding the preferential treatment of green bonds. And I'll invite Matthias to proceed with the presentation. Thank you so much.
Okay, I hope that you can all see my slides and hear me.
Yeah,
okay, so yeah, cool. Then thanks a lot for putting our paper on the program and for joining the session. The paper is titled The Preferential Treatment of Green Bonds. It's joined with Francesco, Giovanardi, Lucas, Radke, and Florian Wicknig, who are also at the University of Cologne. And to motivate what we are doing, I'm going to quote the ECB actually from their recently concluded strategy review, where the ECB stated that they will be ready to support innovation in the area of sustainable finance and explicitly decided to accept sustainability-linked bonds as collateral. And that has been headline policy news in Europe. What has been not so much headline policy news in Europe was that the Bank of China actually implemented a policy like that in 2018 already. And there is a small empirical paper by Macquarie and IIGF that shows that there is a large significant effect on green bond yields after such implementation of such a policy. However, at the moment, the literature is short of a model that can evaluate the effects not only on green bond yields, but also on green bond issuance, green investment, pollution or environmental damages, and potential adverse side effects of such a policy. And that's what we're going to do in this paper. So we take an off-the-shelf RBC model and augment it along a couple of dimensions such that we can talk about preferential collateral treatment. The first one obviously is going to be an environmental externality. The second is that we will have firms that issue risky bonds and banks that use those bonds as collateral. And the basic idea or the basic mechanism in the model is that banks will increase demand for bonds that can be used as collateral. So a preferential collateral treatment of green bonds will induce banks to demand those green bonds even more than before. And firms actually cater to this increased demand by increasing their bond issuance, their investment, and also their leverage in response to such a preferential policy. And in the optimal collateral policy by the central bank is then determined by a trading of three effects. The first one, that relaxing collateral policy increases supply of collateral to banks, which is a good thing. It has an adverse effect on risk-taking incentives by entrepreneurs. So relaxing collateral policy too much will have adverse side effects on financial stability as measured by default risk in the non-financial sector. And it also considers the potential to subsidize green investment. And we find five distinct things in using our model. The first is that maximum preferential treatment in our numerical analysis is quite powerful, but less effective than taxation, which we always use as a benchmark, first best instrument to address environmental frictions. We find that preferential treatment has adverse side effects in the sense that the subsidizing of green leverage or leverage of green firms is interfering with financial stability. So higher risk-taking on the green entrepreneur side will have a downside effect such that the optimal collateral framework is not as preferential as the maximum preferential treatment the central bank could implement. So we already have in optimum kind of a dampening on the effects of preferential treatment precisely due to these adverse side effects. We also see that we find that preferential treatment is sort of an imperfect substitute for standard carbon taxation or Pigouvian carbon taxation. So whenever taxes can be set optimally, there is no preferential treatment necessary. However, we find small scope for policy interaction, and I will show you in detail how that looks like in the model. Because ambitious environmental policy by the fiscal authorities, so by implementing high carbon taxes, has an adverse effect on financial stability as well, and I will show you in detail how that works. And collateral policy will optimally react or adjust its policy in response to such a taxation. Okay, Related literature, very briefly, environmental macro models have been started roughly 10 years ago, and we should mention Heutel and Golosov and co-authors, which have been adapted to the use in monetary policy analysis only very recently. So there are a couple of papers that study interest rate policy, credit policy, green refinancing operations, green QE. We bring the analysis of green collateral policy to this relatively recently developing literature. Okay, so since we are proposing a model in the paper, I will start with a couple of standard agents, which are completely plain vanilla macro agents in that sense. So we have a standard household that is saving through deposits and has a standard consumption savings decision and a labor supply problem. We have a final good firms that is buying intermediate goods from two types of firms, from conventional and from green entrepreneurs. And the production function looks like that. So it's practically a staggered Douglas aggregator with the addition that we add this environmental externality, which we simply call pollution, calligraphic P, which is directly following Golosov and co-authors, which has a negative effect on total factor productivity. So the higher the pollution, the lower aggregate production. And crucially, we assume that pollution is increasing in the number of conventional goods produced, so in the amount of conventional capital in the economy. Okay, so that was like the standard part for coming up with an environmental macro model. What we add now is that we have banks that supply deposits and buy corporate bonds, denoted BC and BG. One issued by the conventional entrepreneur, BC, and one by the green entrepreneur, which is BG. Their prices are denoted by Q. And to introduce a role for collateral, we assume that there are two sub-periods. So like in this money search literature, a morning and an evening period. So in the first sub-period, banks participate in a deposit and a bond market. They choose how much deposits they take from households and how much bonds they will buy. And in the second sub-period, they are hit by an uninsurable liquidity shock, which they settle against collateral. And the available collateral is given by these B bar here, this expression, which depends on the market value of conventional and green bonds, each of them weighted by a collateral policy parameter phi. Phi can capture two things. First, an eligibility threshold, such as a minimum rating requirement, for example, or a haircut. So a collateral easing or a relaxation of collateral policy in our notation will be a phi CT increasing or phi GT increasing. It depends on which collateral you want to treat preferentially. So in our model, phi G actually, which then means that a larger share of green bonds is accepted, or that all accepted bonds get a lower haircut. Okay, this liquidity deficit has to be settled in a costly manner. We are following the macrofinance literature there and assume that these cost function, which we take from Piazzesi and Schneider, is decreasing in the amount of available collateral. So the marginal or the derivative of the cost function with respect to aggregate collateral is negative. Okay, the standard bond pricing expression follows from the maximization problem of banks. So they maximize current period profit subject to a solvency constraint, which yields a very standard pricing expression, which is due to this cost function, which declines in aggregate collateral, has a wedge here, and like an Euler equation wedge, which is responsible for this collateral parameter showing up in the bond pricing expression. So the central bank can actively play around with corporate bond prices by adjusting this parameter phi tau here. And it can do so selectively for green and conventional bonds. And specifically increasing this parameter makes the overall bond price increase, because this omega b here is negative in the denominator makes the entire term go up. So preferential treatment of green bonds would, ceteris paribus, imply an increase in green bond prices. Okay, final building block are the entrepreneurs. I was already mentioning that there are two of them, the conventional and green ones. They are more impatient than households, and they are risk neutral, which are tractability assumptions mostly. Technology is going to be linear, so we are also very simple on that. And we follow the standard financial accelerator literature by adding an idiosyncratic productivity shock M. And to make or to introduce a notion of financial stability, we assume that entrepreneurs can default on their bonds, and they will specifically do so if the production revenues fall short of their repayment obligations. So if their idiosyncratic profitability is low in a specific period, and this default threshold then depends on leverage, more or less. The firm maximum or the entrepreneur maximization problem is then subject to budget constraint, which is simply stating that consumption, which you can think of as dividend payouts and investment, have to equal the amount of bonds raised from banks, so Q times B. They increase in the amount of investment from the last period, conditional on no default. So if there's default, revenues go to the banks. And conditional on no default, they have to repay back legacy debt BT. And I'll save you the algebra of deriving the first order conditions for bond issuance and capital holdings, and simply show you a simplified version of the model where we assume a very tractable uniform distribution. We are, of course, going to relax it in the quantitative analysis and show that the risk choice, which is in that sense the default thresholds of productivity such that the firm defaults, that this has to satisfy this equation here. The equation tells us that marginal default cost, as measured by this risk choice parameter, have to equal the relative impatience. So that is a standard trade-off again in macrofinance, that the borrowing agent, the more impatient one, trades off the benefits of front-loading consumption against defaulting in the future. And crucially, in this entrepreneur trade-off, the collateral parameter is still showing up, which means that the central bank has an indirect way of manipulating or affecting the risk choice of entrepreneurs by affecting this trade-off here. And we show analytically that in equilibrium, by affecting the optimal financing decision of the entrepreneur, preferential treatment can increase the green bond amount of green bond issued, the size of green investment, and it works a bit like a direct subsidy. It depresses the price of green green goods. And these effects are consistent with empirical literature, which I have to skip for time constraints. However, what we can also show is that the increase in capital is bounded by the increase in debt. So there is no full transmission of this policy, which, well, it directly follows from the idea that leverage increases as well, right? So if bonds increase by 1%, capital will roughly increase by 0.5%, implying a small increase in leverage. And this is what we are going to see in our numerical exercises as well. Okay, so key to our model is that central banks can affect the bond pricing of banks, which in turn, by subsidizing these bonds, affects the entrepreneur's choice of borrowing, capital investment, and leverage. Okay. To get a quantitative sense of how relevant all this is, we calibrate the model to European data, which, again, the standard agents are very conventionally calibrated following the RBC literature. The financial side, we mostly follow Gomez, German, and Schmid, which provide a calibration in a model of entrepreneurs with default risk as well. We use collateral parameters such that the equilibrium share of eligible bond is matching the data. And these liquidity management costs omega, which I was showing you a couple of slides back, are parameterized such that they match the empirical eligibility premium, which we take from a recent working paper by Pellisson and Cortes. Okay, the environmental side is relatively standard, again, following Golozov and co-authors, and we take a size of the green sector to be 20%, which corresponds to the renewable energies share in the EU 2 years back. Okay, what we do with this is we are conducting 3 main experiments. The first one is to explore the potency of preferential treatment by increasing phi g to its limit. So in a sense, we're setting it to 1. So every green bond is accepted without a haircut, which is the maximum the central bank can do. And we find that, again, starting from this baseline of 20% green bond share, under maximum preferential treatment, the green bond share decreases by 1.46 basis points, so which is almost 10%, so quite sizable for such a policy, and also still a sizable increase in the green capital share. But again, we have this limited pass-through I was mentioning a couple of slides back. However, this will increase collateral supply above its optimum level, so there is too much default risk and a relatively small liquidity benefit of having so many green bonds around. So we conduct an optimal policy analysis to contrast that against the maximum efficacy of such a policy by varying both collateral parameters over the entire policy space. And we find actually that if the central bank chooses its collateral framework optimally, there is less preferential treatment than possible, which is neutralizing these adverse financial stability effects of having too much collateral and too much default costs around. That implies that green bond and capital shares are only increasing by a bit more than 0.5% for the green bonds and a bit less than 0.5% for green capital, which does not look so impressive anymore. And to benchmark these against the candidate instrument to address environmental externalities, namely a direct carbon tax, we compute the globally optimal policy. And we see that the taxation is an order of magnitude more powerful. And crucially, it also does not disturb the risk choice. It simply affects the output prices of green and conventional entrepreneurs, so making green production more attractive and conventional production less attractive. And it does not play around with the leverage choice of entrepreneurs, so there are no direct adverse side effects. However, ambitious carbon taxation, so a large tax in that sense, will slightly contract the economy and also contract the bond issuance of all agents, simply because you want to get rid of the externalities or reduce economic activity, which has a collateral scarcity effect in the sense that there are simply less bonds around because the economy is smaller, and collateral policy addresses this effect by slightly tweaking its collateral framework, but it's going to do so in a symmetric way. Okay, so under optimal taxation, there is absolutely no scope for preferential treatment. And I'm going to show you briefly how this looks like in numbers. So the baseline is, well, it's the baseline, and the maximum preferential policy is column 2 here, where we set the green collateral parameter to 1 and the conventional to 0. We see slight welfare gain and 0 collateral premium, obviously, on conventional bonds because they cannot be used as collateral in that setting. And that translates into an increase in green leverage, a relatively strong increase in green bond share, green capital share, and a reduction in the pollution costs. Under optimal collateral policy, I mentioned the equilibrium capital shares and bond shares are less tilted in favor of green bonds. And the overall welfare gain, however, is a bit larger, precisely because it avoids these financial stability effects of massive preferential treatment in column 2. The benchmark is then the simple tax. So we simply compute the welfare maximizing tax parameter and see that here the welfare gain, it's already an order of magnitude larger than what collateral policy can do on its own. We see it has massively larger green bond share. We see full pass-through because leverage is constant. There is no adverse side effect. Full pass-through of green bond shares to green capital shares, and a much more drastic reduction in the pollution costs. So again, it's like a factor of 10, so an order of magnitude. And here we have a tiny welfare gain of addressing these collateral scarcity effects, pointing towards this interaction between collateral and fiscal policy. Okay, we do a couple of robustness checks, and the material results are virtually unchanged. Also, adding a new Keynesian block to the model does not really change the game. Okay, I think I have like 2 minutes left if I took my time correctly. So this graph is showing the degree of preferential treatment as taxation approaches its optimal level. So the optimal tax from the previous slide, it was at 8.5%. The optimal carbon tax, and as soon as taxation gets to this level here, preferential treatment vanishes. So 0.2 was the renewable energy share, so the share of green bonds. So this is kind of the neutral portfolio the central bank can accept as collateral. So if we approach this optimum here, the preferential treatment declines back to zero, in the sense that 20% of all accepted collateral is green, which is what happens without preferential treatment as well. Okay, welfare gains get lower and lower the better the tax works. And yeah, we have a plausibility check regarding ECB announcements of such a policy. And I mean, I'm not going to walk you through this because that is, I think, exhausting my time too much. But bottom line of this exercise is what we find in a model when we let the policymaker announce a preferential treatment 3 years from period 0 on, we get a very close, a very closely aligned value to what the data announcements actually revealed. So we got that as kind of a plausibility check that we are not exaggerating the effect of preferential treatment on green bond spreads. Okay, so to conclude, we add an analysis of the effectiveness of preferential collateral treatment to the current policy debate. We have a theoretical result that preferential treatment induces risk-taking by green non-financial firms. It is nevertheless effective at stimulating green bond issuance, but the path-through to green investment is relatively limited due to these financial frictions. We go on to characterize maximum and optimal preferential treatment and provide a quantitative idea of how large they are. At the optimum, pure preferential treatment is medium effective, especially if that is compared to the optimal Pigouvian taxation and the welfare effects. Okay, I'll leave it at that and open the floor for discussion. Thanks for joining, and yeah, back to Martina.
Thank you so much for your presentation, Matthias. So yeah, I'll just check if we've got any questions coming through. I haven't seen anything on the chat yet. So I'll just see if anyone else or any from the other presenters has any additional remarks or questions at this particular point. If not, I'm just going to ask my own question. So if you had to formulate your findings into policy recommendations, what would be your sort of main takeaway from the findings and from the various experiments that you conducted?
Yeah, so if you follow the current discussion about how effective the carbon tax schemes are, you probably conclude that they are not at the optimum that we actually need. So our results would imply go for it, do the preferential treatment, but consider do it under a financial stability consideration, right? So simply don't go to and accept every green bond, but do it in a modest way, taking account the primary objective of the central bank. So in some sense, it would correspond to implement the optimal collateral policy, in a sense like reduce maybe the minimum rating requirement on green bonds considerably, but not to zero, and don't accept everything. I think that is how you can interpret the findings if we assume that the currently implemented carbon taxes are below their optimum. So yeah, I think that's a way of putting it.
Okay, great. Thank you so much. So we haven't had any other questions coming through at this particular point. So just doing a final check if we've got any more questions. I can't see any coming through at this point. So since we've almost reached the end of our session for today, I will just then use this as the opportunity to very much thank our presenters for their insights and for sharing their papers and presentations with us. We have definitely heard a number of very interesting studies and insights. I'm really curious to see, I think, how these studies develop further, and in particular also the insights that we would see in terms of, you know, developing the either managerial or policy recommendations from those as well. So thank you so much for the presenters in the session. Thank you so much for joining us today for this particular session. And I will probably see many of you in one of the following sessions as well. So I hope you enjoyed these presentations today. I hope you enjoyed the discussion as well. And thank you so much for your support for this particular conference here. It's great to see so much interest, and I think this is such an important and emerging area as well. So it's really great to see so many new papers and projects coming through. So yeah, that concludes our session for today. And yeah, once again, a big thanks to all of you, and we'll conclude from here. So thank you so much.
Thank you.